This is number 2 question from Matt in Texas. Keith, I'm struggling with how best to help my retired parents, they're 70 plus, invest. I've gotten them to buy gold and tips, but they're mostly out of stocks as of February and haven't gotten back in. Any thoughts on a portfolio for retirees who are skittish about drawdowns? Well, first of all, I think thinking about drawdowns for somebody that age is probably the most important thing, because especially when you're really like relying on this income, a drawdown is what could crush you. So obviously great job avoiding the February drawdown. So
yeah, I mean that's an interesting question. I think this isn't going to shock people, but I don't think of people's age as being as important as how they think about their capital, right? So I don't care if you're 25 or 95, and people that are that's CFAs and stuff, they'll be like, how did he say that? Let's just start with this. Don't lose your effing money, okay? So that'd be one good thing to think about from the age of 25 to 95. So if you have any money, let's start with that concept, okay? Allocating 60-40 or whatever it is that somebody wants to get paid on, that is what they're trying to get paid on. It's clearly not proven to have no drawdown risk because you're buying certain kinds of things, okay? So if you, so take your grandma's pie, if you're talking about, because how old did he say his parents are?
He said they're 70 plus.
Okay, so currently, let's say that a conservative pie has 50% of what they have in stuff like gold and treasuries and tips. You already rattled that off. You could easily have that. Because gold, if it's 12%, you have tips at 10, there's 22. Keep adding them up. You go 10 at TLT, there's 32. So again, and then you say to yourself, you keep going, SHY is another 10. You can get to over 50, no problem. Let's just say at least 50, okay? And by the way, the most important part of that pie is taking the 12% of gold out of the pie when we tell you to. You can't be non-active about this. Having gold in there at one point matters, in as much as having the dollar in there at one point since when we said put 12% of your pie in a currency in the middle of 2018, it was the dollar. So again, the complexion of this side of the house changes. Think of this as your lower beta, lower volatility, so you can gross up the positions more, parts of the pie. Then you start to go to your equities and commodities. Again, you got a lot of things that you can do there, but they're not what your old wall broker told you to do. It's not like, well, I'm going to buy some value stocks because my parents don't want to lose a lot of money because they're value stocks. That's stupid. It's quite literally the stupidest thing that you could do, right? So again, I think, and obviously they haven't been listening to you because there are plenty of things that they should be in since February. Utilities, REITs, those are great. Lower volatility equities most of the time, but not all the time. They generate income. That's another important characteristic of those, in particular, those two things. And by the way, why wouldn't a 95-year-old want to have some tech?
Yep.
He's going to be dead when he's 96.
It's true.
He's going to be, at least if he's not dead by 96, at 106, he's probably not going to know what to do with it anyway. It's just like, so just think about your money in practical terms as opposed to all this bullshit that's been sold to you by a bunch of technocrats.